for the special webinar with Jay Soloff. Before we get started, let's take a look at the share disclaimer. Be aware that neither Market Chameleon, Jay, or myself are registered investment advisors or a broker dealer. We are not giving investment advice during this webinar. This show, as all our shows, is for informational purposes only concerning Jay's, Market Chameleon's tools and products. With that, good Monday morning, Jay. It's been a while, my friend.
Yes, it has. Yes, it has. Thanks for having me back.
Oh, always a pleasure. Always a pleasure. You bring a wealth of knowledge concerning, well, investing in general, but you have a depth of knowledge in the options space, and a lot of the Chameleon family participates in the options market. And obviously, the way we met is Market Chameleon tool, which provides a lot of unique insights and data points that the Chameleons take advantage of. I know you use a few of our tools as well.
8 years
With
now.
that,
I've
what's
been
today's
using it
webinar going to
for,
be about?
yep, I've been using it for 8 years. So
Eight
I don't know.
years.
I
We've
don't know
been
how
around. I
long.
think we've only been around 8 years.
Yeah, no, literally, I think the first year you guys came out, I started using it and I'm still using it 8 years later. So
Yeah.
it's good.
Well, that's great news, and it's nice to have someone is in your wheelhouse using it every day is a big deal. It means a lot to us. So today's webinar is going to be focused on a type of ETF. Is that correct?
Yes.
And how, as we're going through it, how do you, if someone has a question, we are both doing a Zoom webinar. So people are on the Zoom right now and can ask questions by raising their hands. And we are also on YouTube streaming live. Do you want to wait to the end for some questions, or how do you want to approach that?
No, I've always been, let's just, I like questions that make sense in the scope of what we're talking about. I'm happy to answer them as we're going.
All right, perfect. Well, let's get started.
All right. Our
Always good to get some dead air. Are you trying to bring up a screen or?
Oh, sorry. For some reason I was thinking you were going to bring up a screen. Yeah, I actually let me do that. Sorry. uh yeah, for some reason I was thinking you were going to bring up a screen and ask me some questions, but it's been a while since we've done this and so I'm a little rusty. So
Oh, no worries, no worries.
all right, so yeah, now that we have everyone's attention, it's I haven't had my coffee today. I was really distracted with stuff coming out early, so I'm a little couple beats behind my normal self. So
So
all right,
I
well,
guess before you go around the Chameleon and take a look at stuff, what are these derivative income ETFs?
yeah, that's exactly the place I wanted to start. So thank you for that cue. See, look, we're getting back to our old ways almost immediately. So the I'm sure a lot of you have probably seen by now that options, they call them derivative income strategies, is like the generic term now for this whole category of ETFs. It's really exploded the last, let's say, 2 years, but the whole using options within ETFs that's been around for probably pretty quickly after the great financial crisis, right? So really it's been, I mean, roughly a decade, maybe 12 years since these things really came out. There's a few, covered call ETFs that came out, um and they were, moderately popular, but there wasn't a whole lot. And what I mean by these covered call ETFs is that you're not doing any of the options yourself, right? You are investing in the ETF just like a stock, and within that strategy, within the ETF, they're buying an index and selling a call against it, right? That was pretty much what was out there. And then there's a put right one. This is basically from just emulating the CBOE put right index and their cover call index, BXM or whatever it is. And so you had a few of those, right? Things really took off around kind of around the right before the pandemic, or right, around that time, is, if you're familiar with JP Morgan's hedged equity strategy, it's this massive, massive strategy. That's a put spread collar, right? That's all it is. It's selling a call, using the proceeds to buy a put spread, and doing it around, large cap equities, S&P 500, something along those lines. This was a mutual fund for years and years, and eventually they launched it as an ETF, right? And for SPY, and it kind of came out for some of the different indexes, but SPY is kind of the main one, S&P 500, SPX, and it had accumulated billions of dollars, right? This is just this massive, and it's still by far the largest of kind of these option ETF strategy type products. But it's, I think between the mutual funds and the ETFs and stuff, I mean, there might be something like 40, 50 billion, or maybe not quite that much, but there's billions, right? Like 30 billion. It's something along those lines, right? It's a major product for them. It's done very well over the years. And so it really kind of opened the doors for some more of these strategies. And you started seeing, more kind of specific, tailored versions of this JP Morgan hedged equity, which again is just a put spread collar, right? But and just, if you're not familiar, we can look at one, but all you're doing is selling a cover call, but instead of collecting that premium, you're using the proceeds. Like with the normal collar, you generally use those proceeds to buy a put. All right. And with a put spread collar, instead of buying a put, you're buying a put spread, right? So you're protecting your downside to some extent. You're capping your upside to some extent. You have some wiggle room where you can move around in there, right? Pretty common, very powerful strategy. So you started seeing some different variations of this using on indexes and more specific groups of stocks. But what's kind of really taken the investment world by storm is these single stock covered call, right? Like that. It started with, so YieldMax is the big player in this space, and it started with Tesla,
Actually,
and
Jay,
yeah,
we did have a question from Rob right out of the gate.
yeah.
Rob's a regular in the morning show, a friend of ours from Chicago. He asked, "Can Jay describe the process that YieldMax uses to make tremendous dividends?" That was his question.
That's, yeah,
So,
and thank you. Yeah, and Rob, like I didn't pay Rob to cue me, to give me a cue there either, but that's exactly what I was about to do. So thank you for that.
no,
Thank you, Rob.
Rob literally comes on as many mornings as he can. For those who don't know, we have a morning show, which Jay, you're always welcome to join. We do, I know it's a little bit early for Arizona time, but we do a show every morning. It used to be strictly pre-market, talk about what's going on in the pre-market and walk through some Chameleon tools. And now it's basically a different webinars based and any questions that Chameleons have every day. But we do that every day, 9 a.m. Eastern time. And if you go to the YouTube channel, MarketChameleon.com, YouTube, and just search for us, you'll be able to get to our free YouTube shows. So just a plug. Sorry about that.
Oh no, that's great. I have done one or two of those. I always enjoy it
You have.
because my
You actually
favorite
did
thing
a
is
you actually
just
did a
kind of,
couple for me that when Dimitri was away.
that's
And
right.
and
That's right.
Rob
Yeah.
Rob was actually one of the chameleons who led the charge that he wanted to have the show while Dimitri was away. So I reached out. I think you did two shows. I had a couple other people who have used the chameleon and have friends who like to listen to their insights into the marketplace help me that week. So, anyways, Rob, Jeff, Rob, Jay, Rob. Uh,
All right. Well, thanks for that. Thanks for the question, Rob. Because yeah, so what we this is kind of what I wanted to focus on. Um, these single stock ETFs they're very interesting. Yeah, they're extremely interesting products for several reasons, which I'll get into. And so YieldMax, really, they started with Tesla, which is still one of their biggest ones, and then Nvidia is another one that they have a lot in, and now they've done some funds, and they have some inverses, which we'll talk about. But it's pretty interesting. Now these things are exploding, and now there's stuff involving like Bitcoin and Ethereum. So that stuff has gotten excited. So there's a whole host of all these different strategies out there. They've really, really taken off. So YieldMax is kind of the big player in the single stock space. So what they did, really, it's just kind of monthly covered calls on Tesla, right? But what they do kind of specifically is they will, they'll do something like, let's just go a month out. Um, we'll just go to the next monthly expiration just to for fun here. It's probably tighter markets, and they'll do like a synthetic position. So they don't hold stock. So they'll buy a call and they'll sell a put, right? So this might be their so right, this is stock, right? When you do a buy call sell a put, it emulates stock, right? There's no dividends involved or anything like that. I mean, obviously that'll to some extent be taken into account with like put prices but and Tesla's not a dividend stock, but essentially what I'm saying is that when you buy call sell a put, it is a synthetic stock position. So that's what they do. And instead of buying the stock, right, because options are levered, involve leverage, they're levered, they take that money and they put it into treasuries. So there's some kind of so you have this exposure to Tesla and then you have, whatever payment you're getting from interest. But yeah, and then of course they do the call component. So the call component's going to be monthly. It doesn't have to match up with wherever they're doing the synthetic position. So let's just say they're doing 30 days, closest to 30 days, January 10th. And then they're pretty aggressive on the calls, right? So they usually sell, I don't know what delta, like I think it depends on the stock. They're pretty aggressive. They will pick, you know, they probably give this thing maybe 5%. So what will that so let's just round this to 400. 5% is 20. And so maybe they'll go up to like a 405 or something like that.
And
Or
what do they
let's
do when the stocks, they have a strategy for when the stock's ripping? I mean, are they constantly rolling out of these things?
not
I'm sorry, I didn't
really.
mean to
That
get ahead of you, but
Yeah, no, not really. It's kind of a set it and forget it. I think they don't roll from what I've seen. They don't roll the call. They go until it expires and then they do another one. Maybe they roll it on they roll it. I'm assuming
well,
they
at some
roll it.
point they have to roll or the stock they own is
Right.
going to get
They
called
roll it
away,
at the
right?
very end, right, to
Yeah,
make sure they don't get
I
to make
got
sure
you.
they don't do it. They don't want any stock in their account, right? But they don't want short stock in their account. But beyond that, they don't roll it early from what I'm sure they have the ability to roll it early and maybe they tweak it here or there, but for the most part they're going to hold this thing to expiration. Um, so let's say they do the 410. And if you look at this, you know, this is what a covered call looks like, right? This is exactly if you were to buy stock, sell a call, you have the same exact chart. So they have this position and what they're doing is that they are paying out the call premium every month, whether the stock is up or down. So this is the part that is kind of can trick people, right? So let's look at Tesla. Tesla is that one YieldMax Tesla option strategy, right? And if you look at it, the dividend yield looks like it's 66.7. And it's some large number, right? This is only $15 stock, so 44 cents is a big chunk of that, right? So what they're doing is they're paying out that monthly distribution, but they're paying out that is not profit. What they're doing is they're paying out that call, whether or not the stock is up or down. So essentially what you're doing is you're exchanging the possibility of growth and getting capital gains for the strategy of picking up distributions every month. Now, this is not good or bad on its own. I mean, there are some, you could argue there are some tax benefits, there are some things, but on its own, this is not good or bad. It's a different way of doing it, right? Instead of buying Tesla, waiting for the stock to get up, now you're selling calls, or let's say selling way out of the money calls and trying to capture capital gains. Instead, they're being aggressive, capping potential growth, but they're getting these aggressive payments and then paying them out monthly. Now, when the stock is high volatility, right, that's going to be a decent amount of money. But the one thing that you have to remember with these, and this is kind of the trick, is that this is not, when they're paying that out, the stock amount is going to go down by that amount, right? So I don't know if this is correct because it changes this is probably what they did last month, and it changes every month, and you don't necessarily know until right before they pay it out. But let's just say it's going to be 40 cents again, right? This stock is going down by 40 cents. So all else being equal, you're just breaking even. If you buy the stock before X dividend and then you sell it after X dividend, in theory, if the stock doesn't move beyond what it's paid out, you're breaking even. So you're not making money on these distributions, just like any other dividend. You still want this part to go up or stay still. Now, if this stays at 1568 and you're collecting 40 every month, right, then you're going to make 66% on the year, right? So you can make decent money. How does the stock stay still? Well, this underlying stock also has to go up, right? That is the key. This is a bullish trade. You have bullish exposure to Tesla. If you do not get movement up in the stock at least a little bit, then the distribution is just going to eat into the stock price and you're not going to make any money, right? And worst case, it goes down. And if it goes down, then obviously, so you look here, right? It doesn't matter that they're paying distributions every month. If the stock was going down, you were losing money. Now, lately, obviously, Tesla had a couple nice moves. You got in here at 12. All right, you've made whatever, $3 on the stock, which is, whatever, 25%. But now you're also collecting these nice distributions along the way. And you can see it always goes down at X dividend. Every time there's an X dividend, it goes down. That's fine as long as you're bullish. So you only want to do this thing if you're bullish on the underlying, right? So that is the kind of the key with these. But it's a nice way to capture the volatility. It's a nice way to have someone else do it for you, right? You don't have to do it yourself. And right, I mean, again, if you're good with options, is it that hard to do a covered call and manage that? No, not really. But if you don't want to mess with options, if you don't have time, also the benefit of this is that Tesla is, what is it? $386 stock. You can get bullish exposure to Tesla with Tesla for $16, right? So there's also you're paying a much smaller share price, which is also kind of a nice little benefit. That's kind of unrelated to, that's just they can launch these things at whatever stock price they want, right? So I think they've launched the more recent ones at 50 just to give them a little more flexibility. So originally when this one came out, it went way down. Tesla was on a downward spiral and they had to reverse split, right? So because the distributions just meant it was going to keep going down and down and down. Eventually they reverse split. And now they're launching their newer stocks at higher prices. Like I think this is one for Palantir, and you can see it's 68. They launched it at 50. So it gives them a little bit more flexibility with the options that they sell, and they're not having to reverse split and all that stuff. So the other interesting thing they did, and this is, I think, what is kind of, if you're an option trader, this one still should be, and you're comfortable doing cover calls, this one is still pretty interesting. This is the inverse of Tesla, but it's what we call covered put, right? So what's interesting about it is that you're short the stock and you're short a put. So it's literally the complete opposite of a covered call. The selling a put is easy enough, but selling stock, particularly something that might be hard to borrow, is not the easiest thing for a retail trader. I never short stock, right? You have to get, margin, you have to pay the margin fees, all that. They do all that for you. So you could do this. And again, this would be if you're bearish on the stock, obviously, and the stock has been going up. So I think crash is a really funny inverse name for Tesla. They pick some funny names for the inverse. So they have crash for Tesla, and they have fiat for Coinbase, and what is it? Dips for Nvidia, because chips and dips. Anyways, all right. So they have some interesting names there for their. Anyway, so the inverse again, like if you don't think the stock is going down, you don't want to do the inverse, but it's a nice way to kind of collect, almost maybe hedge your position because you're collecting money from selling the puts. And you're shorting the stock, which they do for you with a synthetic, right? It's the exact opposite. They are buying a put, selling a call, right? And again, like that's something you could do as an option trader, but it requires a fair amount of capital and the right, so this is, I think, a little bit even more retail friendly because it's taking a short position stock is not the easiest thing to do as a retail trader. I'm sorry, Will, are there any questions or anything that people have been asking while
We
I've been
did.
babbling on
Well,
here?
Rob asked, and there's a little bit delay. Well, actually, quite a bit of delay between the YouTube and the Zoom. But he was asking, so is it a naked cash secured put with a credit call spread on top? Is what he was asking. I think it was just you just said it was just a covered call, right? Just own the stock, own the underlying, and sell the call against it. But I could be wrong too.
Yeah, for the this is for the regular.
Yeah.
Yeah, it's it's the what do they call it? A combo, right? Synthetic future. So buying the call, selling the put, and
So
then
it's
just a
actually
call.
just like it's like a risk of it's a conversion reverse. They're just selling the put, buying the call. I mean,
Right.
selling the
Yeah,
put,
selling the
buying
put,
the
buying the
call, and
call,
then
right?
selling this, and then selling the call upper call against it. Is that
Yeah,
correct?
so I mean it yeah, so you don't want to I mean you can look at it, right? I see what you're saying. You can look at it as kind of like a horizontal call spread or diagonal, right? You can look at it as a diagonal with a short put, but that's not really what but that's not how it was set up, right? It's set up as the combo, which is a risk reversal at the same strike, right? So you can call it a risk reversal, buy, call, sell, put, and that is that's that synthetic position. Then you're selling a call. I look at that as a synthetic covered call, and that's it, right? Like yes, you can look at it how you piece the different options. You can look at it in different ways, but that's not really. Yeah, and it's not cash secured. They're definitely doing this using margin. That's the benefit, of course, of the ETFs, right? They can do all that. They have favorable margin terms as well, so that's a benefit that they have. So they launched a bunch of these out. Like you can see here, I was looking at SMCI was an interesting one, right? Because SMCI had all those issues where this is a they had this
For
where
microcomputer, yeah, they had supposedly potential accounting issues,
here
maybe,
it
and
is. Yeah.
then
Yeah, so here it is. They had this, the auditor walked away, the stock plunged by a ton. And then they said, well, they start going down. People are like, oh, this company's done for, right? Because accounting issues, fraud, all that, comes to mind. You think Enron, right? And then they said, well, you know what? We're going to satisfy the need, the what the NASDAQ needs for us to stay listed. So it started going up. And then they come out with, hey, we found an auditor. We don't have to restate any of our statements. We just fired the CFO and we're moving on. The stock is back to where it was. So this one's been interesting. And it hadn't been too long since they had launched SMCY, which is, which is another one they launched at 50. But then they had that, you can see it's the same sort of thing, right? You have exposure, just like anything else, even though you're getting nice distributions, you have exposure to the downside. So the same thing hit this stock, and now it's creeping back up. It's moving back up more slowly because you have these big distributions. I mean, look at the last one was, I think, $2.20, right? So you're getting these huge chunks. But again, if you're not bullish on the stock, there's no reason to be in it, right? So, I mean, it's the same sort of thing. You don't just look at these. The mistake that I think a lot of people make is they look at these really massive dividend yields, and all it is a distribution, right? All they're just taking the money it's from the selling the calls and sending it out to you in itself, that is not profit or loss, right? It's only going to be because the stock is going to go down by that same amount. It's only going to be profit if the stock also holds its ground, right? At the end of the day, obviously, like not, I'm just speaking in generalisms here, but it's an interesting thing because it's just a different way to kind of make money on a stock. It's not necessarily good or bad. With this, with this sort of situation, you're obviously making more money on, the volatility is helping you, right? The added volatility is giving you the extra premium, where if you're just going for capital gains, yeah, volatility can help you and hurt you just like that as well, because it makes the stock, but it makes the stock move up and down, but you don't know necessarily through any period which one is going to pay out more. So, I mean, there are, Tesla's got the longest track record. So let's go back to that. I mean, you can do all kinds of comparisons, see which one you would have done. Sometimes you would have been better just holding the stock. Other times you would have been better with, with Tesla. And you can see here that holding the stock here, well, this doesn't show total returns, right? So, you'd have to put in total returns. I don't think you have that, Will, as a feature, but maybe add it to the feature list. Should be able to show total returns on the graph, including the distribution.
That's a good idea. I'll mention it. I will.
So, if we had total returns, this would be a lot closer, but probably because we had a couple 25% up days or 20% up days in Tesla, holding the stock would have made more sense, right? During this period where they're the same, this one's way ahead because this doesn't account again for those distributions, right? So, anyways, so when you compare these, you want to compare total return graph. But anyway, it's interesting. So sometimes it makes sense to be in them, sometimes it doesn't, and it's a cool. It gives you another way to think about stuff, and I always like that, right? I like the ability to have all different ways to trade, and again, like for people that I work with who don't want to mess around with options, these are nice for them. Of course, if I'm doing this for me, right, I'd probably do it myself, right? Obviously with my experience, I'm happy to do the cover calls myself, and then I don't have to just stick to, I can do them every week, or sometimes do 2 weeks and then roll it, and maybe throw a short put in or whatever, right? Right. So if I'm doing it myself, it's going to be a little bit, more dynamic. But this is kind of nice, mostly rules based. Now, what they have that's kind of interesting that I do invest in, like I have money in this one, which is ULTY, which is a bunch of kind of higher yield stocks. It's a fund of funds, right? So this one would be a lot more expensive and time consuming to do on my own. So, they launched it and they had some, it didn't do very well. And the reason I know so much about these, by the way, Will, is Jay Petrocelli is the CEO, and I had him on for a webinar, and we asked him all these questions, and he's really good at doing webinars. In fact, maybe you could get him on Market Chameleon. I bet he would do that. He likes doing these webinars and getting asked questions.
Yeah, that's a good idea. Maybe share his information on
Yeah,
that.
I'll pass on. Yeah, I'll do that. I'll pass on the information. But so we had ULTY and we were talking about it. And he's like, yeah, it wasn't doing very well. And then in October they got permission to do all these different strategies inside of it instead of just selling calls. So they could, and it's kind of stabilized since then. It's been about 10 for a while, and it pays again these really nice. So since I got in, I think I got in, I don't know, September, October. I had a little bit, and then after doing the webinar with him in October, I added a bunch more because I really like what they said about how they're being able to add strategies besides just selling calls. And since then, it's been flat about 10, but you can see you're getting these nice payouts. So I'm definitely way up. And again, this was the launch, and they were kind of tweaking the strategy, trying to figure out what stocks, because they use some of the stocks they already have YieldMax funds on, but some of them are like smaller names that aren't big enough to do their own ETF on, and they just kind of throw them in here. They have like 25 positions, and they're all kind of higher volatility. So it's kind of a cool, fund of funds. And then they have other funds that do all 30 of, I think they're launching a Mara fund this week. And so they have one YieldMax, I think, that just buys every one of their YieldMax funds. That one's pretty popular. And then they have YMag, which does the Mag 7. And those are YMax and YMag are interesting because they do weekly payouts, weekly distributions. So if you really like getting distributions, same rule applies though, right? This is if I pass on anything to the people watching, the one thing I want to pass on is that you want to be bullish, right? Because the distributions themselves don't mean profit or loss. It's just another way of getting exposure. If the stock goes down as well, you're not making any money. So you have to be bullish, or if you're in an inverse, you want to be bearish, right? That is the key. It's distributions don't equal profit. It's and sometimes in some cases they might be returning your money too. It might be return of capital, right? If the stock is going down. So anyway, so that's just stuff to be aware of when you're trading these products is that you still want to have a directional opinion. Otherwise, it's not any different than investing in a stock that, if you think a stock is going to go down, you're not going to buy it, right? It's the same sort of thing. Just because the distributions are there doesn't change that. So, I don't know. Will thoughts or anybody asking questions or anything?
Rob is asking, I read somewhere that weekly distributions are exactly the monthly dividend, the monthly divided into four, so that the total is the same, just the distribution each week.
That's a good question. I haven't actually looked that up. I didn't think that was the case because I thought they were selling weekly options, in which case it'd be different. If they're selling monthly options and paying them off every week, then that would be true. If they are selling weekly options, then that would not be true. And I don't actually know. Um, I could actually look it up. We could do that, right? I can look it
Yeah.
up if you don't mind going to. I guess YieldMax is not a competitor, so I'm not
Yeah, no,
showing off.
you can go, actually, a lot of times we have yield the funds right in it.
Oh yeah.
But yeah,
Oh,
just type in YieldMax.
okay. Yeah. So do you have the fund holdings in there or?
Sometimes I can't say for YieldMax, it's definitely in there. Rob actually is a participant in those as well. A lot of the guys from the morning show like these, so they've been
Oh,
talking about it for years. Particularly this Tesla one, which is
yeah. Oh yeah.
TSLY.
Yeah, I mean, again, it's interesting. So you can see here YieldMax has this is the one that's the universe. This is all their option ETFs. I wanted to go down to so you can see they pay off this weekly distribution. So if we go down to the holdings, we can see really quick whether or not they're doing. Oh no, wait. No, that wouldn't make. No, you're right. You know what? Rob, I think you have to be right because all of these are monthly. All they do is hold the monthlies. And the monthlies are only. You know what they did? You know why? You know why that's probably not the case, Rob, actually, is because of this. This is what I wasn't thinking about. If we go back here, what they do now is they have all these funds in groups, right? So here are all the funds. They just added this Mero one just today, I think. Each of these groups pays a different week of the month, right? A, B, C, D. So if you have one in this group, they pay. YMax and YMag pays weekly. What they're doing is paying out everything from this group or whatever the week before, right? Not probably just this group. So they're paying so it's not going to be the same because what they're going to do is they're going to everything that comes out group A, they'll pay out in, like this week, 10/29 or whatever. So our next one is what is this week? 10 group C. So everything is going to come from this group of stocks. So it is going to be different every, even though these are all monthly, they're all scheduled to pay out every week. So that's why they can do this weekly. So you're just going to get the payment. So it will be different every time depending on the component holdings. There, we just solved something together, Rob. So
Very cool. If you go back to the Chameleon real quick,
yep,
and I don't know if you want to bring up like Tesla,
yep,
TSLY. I'll just show you where if you go down on the right hand side down to ETF info.
Yeah.
and then ETF profile. So
Oh, okay. There we
that will
go.
give you,
Yeah.
it's how we've entered it. Everything has to be double checked, right? But if you click, there's the prospectus is right there above it. So
Oh,
that's the
nice.
link. That's
Good.
the link I was talking about.
Oh, perfect. All right.
Just
No, I didn't know all the stuff had been. All right. Thank
yeah.
you for this. Is actually yeah. I'm I'm one. I'm the sort of person that likes to have everything in one spot, so not having to switch around. So this is actually very useful. So you
Yeah,
have the
no,
holdings right here.
we try. Obviously, if you ever find anything wrong, let us know. But I say we, Dimitri and the developers try, but that was something that was requested years ago, and they put
No,
it in.
that's
I
nice.
just
Yeah,
know.
I like that.
Not that we
So
have to, maybe for another show, but I was reading something, and I think it was in the journal today. I should have shared it with you about what's what's the name of the publicly traded company that their whole business model now it was a
MicroStrategy, you're talking about?
MicroStrategy,
Yeah.
and there is I guess a investment vehicle like it's like double. It's called like Rex or T Rex. Are you aware of
Oh,
this? I mean, I'm assuming you're aware of this.
yeah, I know what you're talking about. I don't know what the symbol is.
Yeah, it's not a big deal. I just wondered if that had crossed your radar. And the volumes seem to be incredible. And the other thing that's interesting is when it was set up initially, the way I understood the
MSTU. Yeah.
concept is bankers were going to create something behind the scenes that would allow the fund to do what it wanted to do with the double of the stock each time.
Mm.
But there were so many people involved, they don't want to, the banks don't want to take the other side of the trade. So they're actually doing it in the options market.
Yeah.
So most of the fund's activity is actually trading those microsystem puts, basically.
Hmm.
It's
Okay.
interesting. I'll share the article with you, but
Oh, that's it. Yeah, definitely have to check that out. Yeah, so I could see. Yeah, I mean they trade 10,000 options, 2.6 million of the stock. Interesting. Then there's one. So YieldMax has the MSTY, which is you can see here, same thing, right? Call and put. So they go all the way out for February for that synthetic holding, and then they're selling the 1213. Looks like it's this week's 420 um, call, right?
that's amazing.
Oh, looks like they have a bunch of them. 430, 400, 500. Looks like they're selling multiple ones. So
So
at
this
different
is their
strikes.
this is their micro strategy fund, basically.
Yeah. So it looks like they actually are, they're not just doing one at a time. And this might be something that they've done. They might add one every week or something like that, but all expiring 1213. So I don't know how long they've been laddering. I'll have to ask Jay Pastorelli about that, but they looks like they laddered, several different ones up here. Um,
Doesn't it feel like, I mean, it's been years since I've been on the floor, and I know the floors don't really, well, don't exist the way we remember the floors back
right.
in the 90s and early 2000s. But with the people who are left in the business and everything's done electronically, don't you think they know when they're going to roll and really squeeze them? Am I wrong with that?
Yeah, I mean that was the issue with the JP Morgan hedged equity, right? Is that they had a quarterly roll and everyone knew exactly what strikes they're going to roll to and I don't know how many percentage points they would lose on that roll transaction. So they started rolling it at different times and then they also started using different vehicles. That's one of the reasons why they launched that the JEPI, right? The ETF version of it, right? Is because they wanted all these different vehicles rolling at different times so
They
that they
wanted to
could
work, they wanted to make it so they could camouflage their, somehow
yeah.
camouflage their trades. Yeah.
Yeah, so I mean, yes, to some extent you can't completely, but yeah, it just that might be one reason why they ladder different calls and things like that. So Jeppy, they actually do the individual stocks. They do the whole thing. They buy all the stocks, and then you can't see it here because that's top 10 holdings. But this is the one that's the put spread collar. Um, And you could see this one alone is 38 billion. So I was right. So they actually have, between the mutual funds and this, they probably have 50, 60 billion dollars or more of, I mean, they just have an insane amount in these strategies. Um, Again, which really opened the door to a lot of this stuff coming out.
Yeah, that
Just
micro
wanna,
strategy, the T-Rex is MSTU is the
yeah.
symbol for it.
And this one is interesting. Um, and there's the holdings, but this one is some Simplify. They have a lot of these funds. They're good ETF company that does a lot of interesting funds. Um, and this one is Bitcoin, but what they do is they sell a bunch of put spreads and maybe call spreads in different asset classes. So it might be index, but I think they can use stuff like gold or whatever, and then they just take all the proceeds and they buy Bitcoin futures, I believe. So that's kind of
So
an
they're buying
interesting
Bitcoin futures and selling other options
to fund it.
against.
Yeah. Yeah, although I think the futures have some issues. I think they prefer to maybe get into the maybe one of these spot ETFs now that they have started to, they've gained traction and they have options and everything. So
It's amazing, right, when you think about it, and that most of the ETFs, the holdings of actual their Bitcoins is at Coinbase,
is it
and
really?
yeah, I think so. I think most of these ETFs, they're not self-securing the asset, right? They're holding them inside Coinbase, and it's just I don't know. It's interesting, and let's hope there's never a hacker who gets in and sucks all the coin out of Coinbase, right?
Well, that's the benefit of doing the futures, right? Because that's at the CME, right? Which has been doing futures since the beginning of time. So
Yeah, no, I think trading any of the products are better on the exchanges. I believe that, but I've owned a closed-end fund for a while in the Bitcoin, one of the Bitcoin funds, and it feels better that it's an exchange. It's traded on an exchange, but I've since found out, which is why I even know this, that it's held at Coinbase, all their Bitcoins. So
was that Grayscale?
yeah, grayscale.
Yeah.
Yeah,
It's the only closed-end fund I was aware of that did
yeah.
Bitcoin. That's
And it's not a closed-end fund anymore. I mean, I bought it when the actual discount was almost 50% at the time, and for whatever reason, I decided to put a little in my retirement account. It turned out to be a winner, but still, who knows? Who knows how things will work out long term? But with that,
yeah,
Jay,
that's
great job. Any final parting words of wisdom for the chameleon community?
yeah. Just like anything else, make sure you understand these funds before you invest in them. You don't need to read through the whole prospectus. The first page with the description and what they're doing is generally just make sure you have an idea what they're doing and what the risks are because some of these and a lot of these newer funds they're still tweaking the strategy, sometimes waiting a little bit for them to get it ironed out. But
Yeah, and I'll give a little inside tip. This has only come to me recently, Jay. I'm not sure if you're aware of it. There's a Google product called Notebook LM. Are you aware of this?
no.
Well, you can upload a prospectus, 10K, a video, and create the AI within Google creates basically like a podcast.
Hmm.
So it will create a discussion between a man and a woman, and describe. So you could bring up that prospectus, and they'll talk about it. So they'll pull out the risks, and it's a very interesting tool for anyone who hasn't used it. I highly recommend it. It's Notebook LM.
Notebook
I use
LM.
it quite a
Wow.
bit, but if you want to listen to it, or at least their uh, and it's usually pretty close. I'd be interested for you to pop in a prospectus of something you know quite a bit about and put it into the app and see how it works for you. Or I use it only on my desktop, so it's not an app, but it's Google's newest AI product. It's been out about 2 months. It's a very, very useful tool.
Oh wow. Yeah,
So,
I'll definitely check that out.
all right, cool. Well, Jay, thanks as always. Anything you're working on or want to let the chameleons know about, or if they want to get in touch with you? I know you do have a couple products and services you have out there. Uh, is there
Yeah.
anything?
Yeah, I'd recently launched a an iron condor product. I'm a big condor fan. Speaking of, I'm still tweaking my strategy a little bit, but it's called 5 Day Income Trader. It's over at netpicks.com if you want to.
Yeah, no, you can share that. Do you have? Can you share it in the maybe in the chat Q&A or something? You want to type it in, and I'll share it on the YouTube.
Yeah. Yeah. Yeah, it's just this is
Netpicks.com.
5 day.
Nice.
Yeah. And so I don't know if it's open on there, but if you go there and you email support and ask about it, they'll like send you to me. Uh, and then I can get people in. Like I think they technically they close these down in between launches, but not if you contact me directly and then I can open it up for anybody. So it's if you're into iron condors and you like the idea of weekly iron condors, it's my latest passion. So that's what I'm doing over there. It's fun. I've always been a big condor fan, so we can do another one of these and just talk about condors sometime.
Yeah, whenever you're ready to go, we'll do that. Rob, who's on at the end, said, I don't see the link. You see it now, Rob? I did just post it. Rob said, excellent presentations. Thanks for all the information, Jay. Uh,
Thank you, Rob. Appreciate it.
you got it. And it was five. Let me go back to the, just so I have it correctly. 5 Day Income Trader.
Yeah.
All right, Jay, with that, good luck with your new venture.
Thank
Keep
you.
me posted when you want to come back, talk about the Iron Condors and the actual what you're doing with 5 Day Income Trader and Neck Picks. As always, you brought a lot to the Chameleon community. It's much appreciated. And thanks for all your hard work, Jay.
Thanks, Will. Appreciate it.
All right. Have a great day, everyone. Thanks for joining us. Just a little housekeeping. Tomorrow we have our morning webinar, 9 a.m. You can check us out on YouTube, MarketChameleon.com. Just do a search for us on YouTube. And then at noon tomorrow we have, or excuse me, at 2 tomorrow we have a webinar on interactive brokers. So you have to go to Interactive Brokers to actually register for that. I will put that in the link as well. That is an Interactive Brokers run webinar. So they control all aspects of it. So with that, Jay,